When people think about diversification, they usually think about spreading their assets across different asset classes, such as stocks, bonds, or real estate. But there's another type of diversification that can be just as important when it comes to retirement planning, and that's tax diversification. It's not just what you invest in, but where you invest it that determines how much you'll get to keep. In today's video, we're going to walk through why tax diversification matters, how to balance your money across taxable, tax-deferred, and tax-free accounts, the role of Roth conversions and Roth laddering, and how to future-proof your plan against changes in the tax code. We'll even go over a couple scenarios when it's beneficial to build up concentrated positions in specific tax buckets. But before we dive in, my name's Ryan Knoll. I'm a certified financial planner and founder of Navigator Partners, a financial planning firm that helps clients nationwide make smart money decisions. Let's jump into the video. So what is tax diversification? Tax diversification means structuring your retirement savings so you're not overly dependent on just one type of an account for withdrawals. There are three main tax buckets. The first is tax-deferred accounts, which are your traditional 401ks, 403bs, traditional IRAs, 457 plans. Contributions are made pre-tax, growth is tax-deferred, but withdrawals are fully taxable as ordinary income. There are tax-free accounts which work the exact opposite way. Those are things like your Roth IRAs and your Roth 401ks. Contributions are after tax, growth is then tax-free, and qualified withdrawals are then tax-free as well. Finally, we have our taxable accounts. These are brokerage accounts and savings held outside of retirement accounts. You pay taxes annually on dividends, interest, and realized capital gains, but the principal is generally tax-free when withdrawn. Having all three buckets gives you flexibility to manage taxes strategically in retirement. So why is all of this important? Well, if all of your money is in tax-deferred accounts, every dollar you spend in retirement will be taxable. That can push you into higher tax brackets, make your Social Security benefits taxable at a higher rate, and increase your Medicare premiums. If all of your money is in taxable accounts, you missed out on years of tax deferral. And if all of your money is in Roth, you've sacrificed current deductions, which may or may not be optimal depending on how much money you make. But if you have a mix, you can choose where withdrawals come from each year to keep yourself in the lowest effective tax bracket possible. You're not locked into whatever Congress decides future tax rates will be. The best time to start tax diversification is during your working years, and here's how you will do it. You can split contributions between traditional and Roth. Many employers now offer both traditional and Roth 401k options. If you're in a low to moderate tax bracket, Roth contributions may make sense. If you're in a high bracket, traditional can help lower your taxable income by way of giving you more money in your pocket by deferring income taxes on those contributions. A balanced approach can give you both buckets. You want to reevaluate this annually to determine where you should be making your contributions to optimize for every dollar. Next is you don't want to neglect taxable accounts. Saving in a brokerage account is often overlooked because it doesn't have tax advantages. But taxable accounts are incredibly flexible. They allow you to harvest gains or losses, access funds before 59.5, and fund big purchases without penalties. And if set up correctly, they can be used to provide tax-free income in retirement. Finally, you want to automate Roth IRAs if you're eligible. If your income is under the Roth contribution thresholds, contribute directly to a Roth IRA each year. If you're over those limits, utilize the backdoor Roth IRA conversion strategy. One of the most powerful strategies for building tax diversification, though, is the Roth conversion ladder while you're in retirement, and here's how it works. Each year in early retirement, preferably before Social Security's and required minimum distributions kick in, convert a slice of your traditional IRA or 401k into a Roth IRA. Pay taxes at today's rates on the conversion, then let the Roth grow tax-free. And typically those tax rates are a little bit lower than if you would have waited. You want to repeat this annually, filling up your preferred tax bracket without splitting into higher ones. Over 5 to 10 years, you can gradually shift a significant portion of your pre-tax money into Roth, reducing future required minimum distributions and creating a large tax-free pool to draw from later on or to leave to your beneficiaries. If you want to learn more about this Roth laddering strategy, it is covered in depth in a recent video we just finished. Check out the Retirement Bridge strategy on our channel for an in-depth walkthrough. Now you want to make sure you're utilizing your taxable accounts strategically. Taxable accounts are the swing bucket within your plan. They don't have contribution limits or early withdrawal penalties, and withdrawals aren't reported as income beyond any realized capital gains. So with these types of accounts, you can tap taxable principal in early retirement to lower your income and make room for Roth conversions, harvest capital gains in years when your income is low, potentially paying 0% federal tax on them, and gift depreciated securities to charity or heirs to avoid capital gains altogether. This flexibility makes taxable accounts the glue that holds a tax-diversified strategy together. Let's go over a brief case study where clients could actually build a three-bucket system that works for them. So let's say we have Alex and Jordan here, and they're both 45 years old, and they make $180,000 a year combined between the two of them. This puts them in the 22% tax bracket, which is a lower tax bracket, meaning Roth may make sense here. But currently, they contribute $30,000 per year to their 401k, and it's all pre-tax. They have $300,000 in traditional accounts, $40,000 in Roth IRAs, and another $50,000 in brokerage accounts. Right now, they're almost entirely in the tax-deferred bucket. If they keep this up until retirement, nearly every withdrawal will be taxable. Here's how they could begin thinking about diversifying their portfolio from a tax perspective. They can start directing new contributions to Roth 401ks. They may want to consider splitting them between Roth and traditional depending on what they're projecting for their retirement balances. This is where a good financial planner could step in and help you determine what makes the most sense for you. They also could think about utilizing Roth IRAs in addition to what they're doing at their workplace plans, where they could put $7,000 each year in for each of them. And they can divert another $10,000 annually into a taxable brokerage account to build a non-retirement pool. By age 65, assuming they earn an 8% rate of return, here's what they're going to have. They're going to have roughly $1.4 million in traditional assets, $2.1 million in Roth, and $450,000 in taxable brokerage accounts. And this mix allows them to do a couple of different things. They can use their taxable and Roth dollars to stay under their IRMA thresholds for Medicare, convert IRA slices to Roth in low-income years, and harvest capital gains within the 0% bracket. They're going to pull from whichever account gives them the best after-tax outcome. And as they continue to progress in their careers, they will likely make more money. So each year they should sit down themselves or with their financial planner and figure out the best place to put their retirement plan contributions. Once they start crossing into the 24 and 32% tax brackets, they may want to defer taxes on contributions if they believe that they will be in a lower tax bracket once they reach retirement. Even after going through all of this tax diversification, the major thing we want to highlight at this point is no one knows where tax rates are going to be a decade, 2, or 3 from now. But here's what we do know. The current brackets are not scheduled to rise in 2026, but government spending and debt create pressure for higher taxes over the long term. States may also change tax rules independently. Tax diversification is your hedge against all of that. By having money in each bracket, you're not hostage to whatever Congress decides in the future. If rates rise, you lean Roth. If rates fall, you lean traditional. If rules change for retirement accounts, you have taxable assets as a fallback plan. So let's focus on what you can control then, and that's building tax diversification before retirement and during the early years of your retirement. So first, you want to take inventory of your balances. Add up your current traditional, Roth, and taxable account balances. Are you overweighted in one area? Next, adjust your contributions. Use Roth options if available, or backdoor Roth if your income is too high. Build taxable savings intentionally. Third, you want to plan a Roth conversion window. If you expect lower income years before your required minimum distributions and Social Security start, use this window to prioritize your Roth conversions. Fourth, harvest your gains smartly. Use taxable accounts to take advantage of the 0% or 15% capital gains tax brackets, which are going to be lower than the ordinary income tax brackets you'll pay when pulling money from your traditional accounts. Finally, we want to revisit this all annually. Tax law and your income will change. Tax diversification isn't a one-time decision. It's a strategy you fine-tune each year with your planner. And as you work through building up these tax diversified buckets, there are some common mistakes you're going to want to avoid. The first is having all of your money in pre-tax. Many high earners assume lowering taxable income today is always best. That can backfire when required minimum distributions and Social Security pile up later on. They also may be ignoring Roth options. Roth contributions and conversions are powerful, especially in low or moderate brackets. Next is neglecting taxable savings. Brokerage accounts may seem boring, but they give flexibility no retirement account can match. There's also one-time conversions that you want to make sure that you're avoiding, which is a single huge Roth conversion, which can spike income and Medicare premiums. A planned ladder is going to work far better than doing it all in one year. And finally, if you're not minding your IRMA thresholds, conversions and withdrawals affect future Medicare costs. So stay mindful of the 2-year look back so you can keep these costs as low as possible as you're working through your Roth conversion ladder. With all of that said, there are still some outlier scenarios when building a concentrated bucket does make sense. If you're a higher earner in one of the upper income tax brackets, you probably want to concentrate on building a pre-tax bucket. The tax savings from deferring income will likely allow you to have a better outcome than you otherwise would be able to have by splitting contributions. Likewise, if you are in lower income years, you should absolutely prioritize Roth contributions or conversion. Being able to pay little in taxes and leave that money compounding for years, giving you future flexibility, is worth its weight in gold. And if you plan on an early retirement, you should not ignore retirement accounts altogether, but you should prioritize your brokerage account first to avoid penalties you would have if you were to pull that money from retirement accounts. You do want to contribute to your retirement accounts first up to your company match, but then you want to focus on your brokerage account. Forecast out your spending needs until you reach retirement age, and backing in an annual savings amount to hit within your brokerage account is the first step. If you can hit that goal and then still have money left over, that is when you go back to funding your retirement accounts up to the maximum limits. So the bottom line here is that tax diversification doesn't guarantee higher returns, but it does guarantee you more control. By spreading savings across taxable, tax-deferred, and tax-free accounts, you give yourself options to manage brackets, reduce lifetime taxes, avoid surprise medics, and adapt to future tax law changes. The earlier you start, the easier it is to build across different buckets. But even in your 50s and 60s, you can still utilize Roth conversions, smart withdrawals, and taxable savings to improve your mix. If you want help designing a tax-diversified retirement strategy tailored to your income, your goals, and timeline, that's exactly what we do here at NAV Wealth Partners. Please schedule an appointment to meet with an advisor on the team via the link in the description below. Thank you so much for watching, and as always, make smart money decisions.